Hi everyone, it's Matt here. I'm the lead trainer at Safety in the Market. And in this video, I want to talk to you about margin calls. And these are really important for you to understand because if you're receiving margin calls, it usually means that you're over trading or buying or selling too much for your capital. And that means that you're putting your money at risk, or at least you're putting more of your money at risk than you should be. So let's have a look first at what a margin call is, and then we'll have a look at some ways of dealing with a margin call. And finally, we'll look at the advice of W.D. Gann, who spent over 45 years as a trader himself and also in the broking industry and dealing with other traders who were receiving margin calls. So let's look at what a margin call is first. Most trading these days is done using leverage. So instead of saving up $50,000 or $100,000 and then buying $50,000 or $100 worth of shares, people will take $10,000, $20,000, $30,000, put it into an account, and they might buy $50,000 or $100,000 worth of shares. And the way they do that is by borrowing the money that they don't have from the broker in order to take that position. In order to do so, they have to put up a deposit, which is called margin. It's a lot like buying a house. Most people wouldn't buy a $1 or $2 million house using cash in the bank or cash in a suitcase. They would have a deposit saved up, maybe 5, 10, 20%, and the rest of the money they would borrow from the bank. Now, this process is very similar whether you're buying a house or whether you're trading financial markets, but there are a couple of key differences. Firstly, in the financial markets, you don't have to make repayments on the loan. So if you borrow $1 million through your broker, you just have to put up the margin and then cover any interest payments, and then you can hold that position as long as you've got money in your account to hold it, or until you want to close it for a profit or a loss. If you buy a house, of course, you're going to have to make repayments on that house loan. Similarly, if you're borrowing to buy a financial instrument, once you have your trading account open, you don't need to make an application to borrow money or see a solicitor or have a contract drawn up like you do with a house. All you have to do is look for an opportunity and then bang, you can jump in there and take it straight away. Whereas if you find a house that you want to buy, you've got to do building and pest inspections, go to your solicitor, apply for a loan, etc. So as you can see, so far, leverage in financial markets is a little bit easier than leverage in the housing market. However, there is one key difference here, and that is if you buy a house and that house falls in value, as long as you keep making repayments on that house, the bank shouldn't bother you. They're not going to ring up and say, hey, the value of your house has dropped by 10 or 20%. Can you please put more deposit up? Whereas in financial markets, if your account value falls below the required level of margin, you're going to receive what's called a margin call. And a margin call basically tells you you no longer have the required amount of margin in your account or in your account value, and you need to fix that. Now, a margin call is not a nice thing to receive, and yes, I have received margin calls in my trading career. When you receive a margin call, it usually means that you're either overtrading or that the market has moved a long way against you. But keep in mind, margin is there for protection. It's there to protect your broker, of course, but it's also there to protect you and your capital. Let me give you an example. Let's imagine that there was no margin and you could borrow as much as you liked in the market. So you might have $5,000 in your account and you might decide that you're going to go out and buy $1 billion worth of currencies. Now, if that $1 billion position moves against you, you might owe your broker millions of dollars, if not hundreds of millions of dollars. Now, you may not have hundreds of millions of dollars to pay your broker, so that's a bad thing for you, and it's also a bad thing for your broker. So the idea of margin is there to protect both you and your broker. Now, if you receive a margin call, you're going to be left with 3 options. The first option is to simply deposit more money into your account. So your account has fallen in value, you just go and put some more money into your account to top it up. The second option is to close out some or all of your positions, because if you're closing positions, you're lowering the amount of margin that's required. And in most cases, once you've closed a few positions, you're no longer in a state of margin call. So they're the first 2 options, depositing more money or closing some or all of your positions. You do have a third option, which is to do nothing and hope that it goes away. Now, that is a legitimate option. You can do that. However, if the market continues to move against you, the broker will then go in and close positions for you if your account keeps falling. And that's not something that you want to see done. You want to be in control of your positions at all times, not your broker. So there are three options that you can employ if you receive a margin call. Let's have a look now at the advice from W.D. Gann. And as I said earlier, Gann is someone who had been around markets for over 45 years when he was writing this information down. As a trader, he would have received many margin calls, and as a broker, he would have been responsible for giving margin calls out to many clients, keeping in mind that he operated during the 1929 stock market crash. So he would have seen plenty of people who had bought up lots and lots of investments on margin. And then as the US indices fell by 90% from 1929 to 1932, that's 90%. They fell from 386 points down to 40 points for the Dow Jones index. And all throughout that time, people would have been receiving margin calls. So when Gann talks about margin calls, he has a lot of experience from both sides as a trader and as a broker. Here's what Gann says to do in the event of a margin call. Gann says the thing to do in most cases is not to put up more margin, but sell out at the market or buy in case you are short. So if you're not sure what he means there, buying in case you are short, as traders, we can buy financial instruments and make money as they go up, or we can do what's called short selling and make money as something falls. In order to do that, you sell first, and then to close the trade, you buy back in. Okay, so that's what he's saying there. Gann continues, if you put up more margin, let it be on a new trade and one which you have good reason for making when your judgment is better. And I really like that advice from W.D. Gann. Think about it. You're receiving a margin call. Something has gone wrong. You've either traded too many positions, which means your judgment is skewed, or you were wrong on the market and it's going against you, which means your judgment is out. So he's saying, cut your losses, get out of the trade, maybe take a little bit of a rest, and then if you want to put more money into your account, do it for a new trade where you have good reason for making that trade and start again fresh. Gann continues and says that 9 times out of 10, after a customer puts up margin the first time, he will hold on until there is a second margin call and a third margin call and put up money as long as he has money to put up and lose all of his capital on one trade. Again, this is not someone who's just come onto the scene lately and observed a margin call or two and said, yeah, I think this is what you should do. This is someone who spent decades in the industry on both sides of it, and he would have seen countless customers put themselves in this position. And he's saying 9 times out of 10, if they start putting up more money, the market keeps moving against them, and then they just keep putting up more money until they run out of money. So again, Gann says the best thing to do when you receive a margin call is just close your position out. That was option 2 that we looked at earlier. He finishes here by saying, if the broker has to call you for margin, there is something wrong, and the best thing to do is to get out. Now, I hope that none of you ever overtrade, and hopefully you'll never receive a margin call in your life. But if you do, and it's not always a margin call, they may just send you an email to say that you need to put more money into your account. But if you do receive a margin call, do the smart thing, just close the trade out and start again. Cut your loss while it's still small and move on to the next trade. The most important thing in trading is to trade with safety. If you trade with safety, if you protect your account, you're going to be around long enough to gain experience as a trader, to understand how markets work, and then eventually to develop experience and winning strategies. And if you'd like to learn more about trading with safety, I'd encourage you to check out our Active Trader Program online training. There's a link in the description to this video. You can click on that link and you can try that program out free of charge, and you can watch those early videos in the program and see if the program is right for you. If you enjoyed this video, please click on the like button. And if you're new to the channel, firstly, welcome. And secondly, I'd encourage you to subscribe to the channel to keep up to date with all our future videos. Thanks for watching. All the best with your trading, and bye for now.